Hello everybody, this is Jinesh and you're watching Road to Intelligent Investing, where we talk about all the interesting stuff in the financial world, especially the stock markets. So in today's video, we are going to be doing the fundamental analysis of a company called Alkyl Amines and also compare its performance with its peers. Let's start with the macro parameter, that is the industry analysis. The global specialty chemicals market grew from USD 577 billion in FY12 to USD 745 billion in FY17 at a CAGR of 5%. It is expected to grow to USD 1000 billion by FY22 at a CAGR of 6%. China and North America dominate the global specialty chemicals market with about 50% of the market share, while India's share is merely 3%. This shows that the specialty chemicals market in India is at a very low level as compared to the US and China, leaving a great significant scope for its growth. The trade conflicts between China and US Europe has created major supply chain disruptions in China. Here, India becomes a great alternative for the US and Europe and could reap the benefits of gradual acquisition of market share. This is true in the specialty chemicals market as well, as China was the biggest specialty chemical supplier in the world. Now let's understand the business model of Alkyl Amines. Alkyl Amine Chemicals Limited was incorporated in 1979 and is based in Mumbai, India. Alkyl Amines Limited manufactures and supplies amines, amine derivatives, and other specialty chemicals in India and internationally. The company offers aliphatic amine products such as methylamine, ethylamine, isopropylamine, propylamine, butylamine, ethyl-hexylamine, cyclohexylamine, amine derivatives including amides, hydrochlorides, and mixed amines, and fine chemicals. The company serves various industries such as pharmaceuticals, agrochemicals, water treatment chemicals, rubber chemicals, paint and dyes, etc., which are all expected to grow rapidly in the coming future. The company's first plant was commissioned in 1982 at Patalganga to make ethylamines with technology from Leonard Process Company USA. Subsequently, the capacity at this site was expanded to manufacture other amines with technical know-how of Acid Amine Technologies USA, and now hosts two multipurpose amine plants with a capacity exceeding 25,000 metric ton per annum. In 1995, it started on its Kurkum complex, where various amines and amine derivatives are currently being manufactured in 9 plants with capacity exceeding 70,000 metric ton per annum. In 2018, it started on its Dahej site in Gujarat, where amines are currently being manufactured in one production plant with a capacity of about 35,000 metric ton per annum. In the last 2 decades, the company has added various facilities to manufacture a wide range of specialty chemicals with its in-house development technologies. Alright, now let's look at the phenomenal financials of Alkyl Amines. First, we look at the growth in revenues. Revenues of the sales have grown at a CAGR of 18% CAGR calculated for the past 10 years. 21% for the past 5 years and 26% for the past 3 years, with the expenses growing only at about the CAGR of 15% over 10 years, leads to a steady and stellar growth in the operating profit margins. Here is a comparison of how it maintained the highest operating profit margins amongst its peers like Deepak Nitrite and Balaji Amines by keeping the expenses under control. Let's quickly look at the current ratio, which is nothing but the ratio of the current assets to the current liabilities, and it is a good indicator of the company's current liquidity. As you can see, there is a steadiness in the current ratio, which is very healthy. Next comes the debt to equity ratio of the company. The debt to equity ratio has remained very low to almost zero and is now currently at 0.03. When we look at businesses in the mid cap and small cap space, we should look for the companies with higher margins and lower debt to equity. Since in these companies, the interest on debt chucks away a large portion of the operating profits. But if these companies are high margin businesses with cost efficiencies, they can pay off these debts quickly and then the net profits grows exponentially from there. Now take a look at some of the important ratios. The ROCE, which is the return on capital employed, calculated as the EBIT, earnings before tax and interest, divided by the total capital employed, inclusive of the debt, has shown a consistent increase in the past years, which is a very good signal indicating the strong performance of the company. The ROCE had a very impressive 15% CAGR over the 10 years. Take a look at the inventory turnover ratio, which shows the number of times a company is able to sell and replenish its inventories in a given period of time. These numbers are very similar to the inventory turnover ratios of its closest competitor, Balaji Amines. Where Alkyl Amine outperforms Balaji Amines is in the number of debtor days. Debtor days includes the number of days between sale and receiving cash. Now let's look at the simplified cash flows. Cash flows from the operating activities grew at an impressive 30% CAGR. Now let's look at some of the qualitative parameters. This is a table that shows us the shareholding pattern of Alkyl Amines, where the promoters are the majority stakeholders at about 74% holding. Then comes the public, which holds about 23% of the company, and the rest 3% is held by FIIs and DIIs. One of the comparisons we can draw here with the immediate peer Balaji Amines is that Balaji Amines had about 1.92% of its shares pledged in 2018, which may not be a deal breaker but is not a very good sign for the company. Also, the promoter is holding just 53% and most of the stake is already distributed to the public, holding 43.7%. Hence, they do not have any future options for further fundraising from further fundraising by selling stake to public through offer for sale. Now let's come to some of the points of concern for an investor looking at this company. First off, a value investor will stay 100 miles away from this company as the valuations are by no means cheap or appropriate. People have discounted cash flows for about 2 to 3 financial years in the future. And the bull market's euphoria has played its part. It is at present trading at a PE of 65. With such valuations comes downside risks. Hence, it is important to use the staggered form of capital allocation in case someone is interested in buying it. Secondly, in the company's con call after the Q4 earnings, the company's promoter Mr. Yogesh Kothari said the gross margins on QOQ basis dropped by about 400 basis points since the raw material costs such as the crude oil and petrochemical costs are going up. Moreover, the management is not sure if they will be able to pass on these price hikes to its immediate customer. So we may see the dip in the operating profit margins and subsequently the profits for the coming at least 2 to 3 quarters. What we need to understand here is that Alkyl Amines is an intermediate manufacturer working in a B2B business model. The main power of pricing lands majorly in the hands of either the B2C business, which sells directly to the customer, or the raw material supplier. Hence, Alkyl Amines has very little pricing power and hence cannot improve their gross margins in case of raw materials price hike. Alright, lastly, let's look at the future plans of Alkyl Amines picked up from the con call of Q4 FY21. In the specialty chemicals sector, 60% of India's capacity is import based. Hence, Alkyl Amine has the opportunity to capture the market share, being the market leader. In the year ending March 2021, 140 to 150 crores was their capex, and in FY21-2022, 200 crore capex is announced. There is a hope to commission the acetonitrile manufacturing site in FY22, so a spurt in the volumes are expected in the next few quarters. Surplus cash and cash equivalents will be used in the expansion of aliphatic amines plant in Kurkum, which is expected to start running in FY22 or 23 with a capex of another 200 crores. All in all, this is a very good company for anybody interested in growth companies with strong financials. That's it for now, guys. Hope you liked this video. If you do, appreciate it by sharing it with your friends and family. And do not forget to hit the subscribe button. Until next time.